Welcome back. Let's get cracking on Module 11, cash flow statements. Cash is king and queen. It makes business succeed because if you don't have the cash flow, you cannot operate the business. You can't pay your bills. You can't buy things. Cash flow needs to be managed. It is key to the success of a business. So let's talk about the cash flow statement and what is involved in getting it set up. And we'll start with the big picture, and then we'll go into each section in detail. So how do we produce a cash flow statement? Well, we need an income statement. We need a balance sheet. There are elements of both that end up on the cash flow statement. So income statement, about the degree to which consumers value the products. These are the folks that are buying the stuff, the sales, and the expenses associated with those. The balance sheet is those resources and claims on those resources, the assets and liabilities. The statement of cash flow summarizes the flow of cash in and out. And we have the forever famous OIF, operating, investing, and financing categories that we deal with on a cash flow statement. Part of what we want to make sure is understood is that it is a summary, and we are able to make decisions and understand how things operate through cash flow. You might have heard of real estate companies. It's all about the cash flow. So they buy a piece of property, they pay a mortgage, and then they have expenses. And if they can make positive cash flow, basically pay down the mortgage eventually, they're in good shape. If it's negative cash flow, they get deeper and deeper in the hole as they go. So the statement of cash flows, as I said before, includes elements of the income statement, and key is the comparative balance sheet. We're comparing the balance sheet items like receivables, payables, things from prior year to current year and changes. We'll talk more about how that gets determined. There's two types of preparation, indirect method and direct. We will emphasize the indirect method. It is by far the most popular and actually fairly the easiest to understand and to work with. So we're going to be using the statement of cash flows. Everybody talks about a balance sheet income statement. The cash flow statement sometimes gets short shrift. So what goes on the cash flow statement? Well, we talked about operating, investing, and financing activities. Those are the types of activities that are involved. And we analyze liquidity, how the role of cash interacts. So we're looking at the cash flowing in and out of the business, called sources and uses of cash. We also have additional details that may be non-cash item. Think of depreciation. Do we write a check for depreciation, or do we write a check for impairments if something is not what it should be in terms of valuation? Those are actually non-cash adjustments, but they do show up on the income statement. So effectively, we need to add those back to see what the cash flow is. And we'll see how that comes together in a cash flow statement. Gains and losses on sales, same type of thing. But the cash portion of interest expense and income tax revenue is a cash item. And finally, we have earnings quality. We have the quality of earnings, but it's based on, well, if our profits are going up and our cash flow is going up, that's a good thing. But what if our profits are going up and our cash flow is negative, is going down? What's the incongruency there? That's what we need to take a deeper dive in, take a deeper look at, because that might be a challenge, and we might see this other problems. So what goes into a cash flow statement? Cash receipts and payments. We have the OIF standards, the operating. Those are customer interactions, mostly the current asset, current liability kind of stuff. We have the investing activities, and that's not investing in us. It's us investing in equipment, land and buildings, machinery, or investing in other businesses. And then we have the financing, which is normally long-term debt and stockholders' equity, the two types of financing we've been learning about. The combined effects of the cash of all these three categories explains the net cash for the period. So if you have last year's balance sheet cash and this year's balance sheet cash, that difference will be accounted for in the statement of cash flows. So we're looking and saying, okay, here's the overview. They talk about here the indirect method. And basically, indirect is all cash that comes in the door and all cash that goes out the door. Checks come in, checks go out. That is part of the indirect, the direct method. The indirect method is preparing. We begin with net income as a start. That's the source. We adjust the net income for non-cash items. We talked about depreciation we have to add back, impairments we have to add back, gains and losses. Gains are not usually dollar gains. They're actually book gains. So gains need to be deducted and losses need to be added back because that will restore the income statement to a cash type statement. We'll see in the next slide a little bit about that. We consider the change in each balance sheet account. So let me think of an asset. If I buy inventory, that's a use of cash. If I sell inventory, that's a source of cash. If I get paid for receivables, that's a source of cash. If I sell goods on account and I don't collect the cash, I'm actually financing my customers. That's a use of funds. So we'll be going a deeper dive in how these look. And the big picture I mentioned before is the current assets down here, mostly operating, current liabilities, mostly operating, long-term assets, mostly investing, and the financing is the long-term liabilities and the stockholders' equity. So let's get a little closer look at a full cash flow statement. I'm going to expand this a little bit so it makes it a little bit easier to read, hopefully. And we're looking at that. Interestingly enough, we start off with net income, including non-controlling interest. So this is total net income, bottom line, net income of where we're at. And then we go in and adjust to reconcile. We have depreciation that we're adding back. We deducted it as an expense, but it's not cash. We add it back. We have deferred income taxes. We have income earned from equity method investees that we deduct. We have distributions received from equity method. Gains in acquisitions of joint ventures. We've got a whole bunch of joint venture consolidation type stuff going on. Gains resulting from divestiture on certain retail operations, stock-based compensation, goodwill impairments, we're adding that back, other. So we then have our adjustments, our change in receivables, our change in inventories, our change in payables, change in deferred revenue. And they're going to either be sources, positive, or uses, negative. And we end up with net cash provided by operating activities. Then we have our investing activities, purchased investments. We bought companies or invested in other companies, or we sold some investments. And we sell them, we get cash in. Maturities and calls on investments, acquisitions, net of cash acquired, additional PP&E, property, plant, and equipment. So we bought equipment, we use cash. That's a negative item. Proceeds from divestiture of certain operations. We actually got paid when we sold off a division or department. And then we have finance. Proceeds from issuing long-term debt, bonds. So we got some cash in the door. Proceeds from issuance of common stock. We got some cash when we issued stock. We paid out cash dividends. That reduces. We repurchased common stock, treasury stock. That reduced cash. Minimum tax withholdings on share-based awards. That was also a use. And we have non-cash used by financing activities, effective change in rates of cash and cash equivalents. So we had something else going on, increase in cash and cash equivalents, beginning of period, straight from the balance sheet, end of period. And the change here is 6,000, but if we go up top, it says a million, so it's really $6 billion for Starbucks. And that's what's going on with an overview of a statement of cash flows. A couple of the things, we'll preview the operating activities. Operating, again, we said was current assets and current liabilities pretty much. Generate cash from selling goods or services, so receivables, payables, those are all linked to operations. And we have inflows, receipts from customers. Okay, so we either got paid for sales or paid by receivables. Receipts of interest and dividends. Other receipts not related to investing or financing activities, such as lawsuit settlements and refunds received from suppliers. So again, that's called operating stuff. Outflows, write a check to the suppliers, to our employees, wages. Payments to buy inventory. Payments of interest to creditors. Payment of taxes to government. Those are all outflows. Okay, so that's a use of cash. Again, sources and uses. Other payments not related to investing and finance activities, such as contributions to charity. Nice thing to do. Non-cash item, net income is the first line, always. But then we have to add back things like depreciation, make other adjustments. basically, as it says here, undo the non-cash items. When we say undo, we're adding back the non-cash items that we deducted as expenses. We add back to offset the expenses negative effect that was on the income statement. So they reduce the net income, but we have to add it back to get rid of those things. Other non-cash sources and uses. Okay. Things purchasing additional inventory, allowing customers to pay later, receivables, using supplier credit to buy inventory, payables. When we incur payables, that is a source of funds. When we write the check to pay off the payables, that's a use of funds or a reduction. But common computation, so we have net income plus depreciation minus increases in current assets plus decreases in current assets. So if inventory increases, that's negative, that's a source. If the accounts pay, if we decrease receivables, we're getting paid, so that's a source of funds. So the increase in current assets is a use, decrease is a source. Increase in current liabilities, as I said, payables, or we get unearned revenue. We get paid monies from a customer or future customer for goods that they haven't received yet or services they haven't received. Our cash goes up and our liability goes up. So an increase in current liabilities is a source of funds. And decrease in current liabilities, we write the check to pay the payable. Or we move things down to the income statement, but when we have debt, deferred revenue becomes actual revenue. So there's our cash from operating activities. So the increase of assets is an outflow. The decrease in assets is an inflow. Decrease of a liability, increase of a liability is an inflow. Decrease of a liability is an outflow. And you're going to want to know that. We've got 2 more slides in this segment, and we'll take a look at a preview for investing. Again, investing is those long-term assets. So we're acquiring and disposing of property, plant, equipment. When we sell equipment, we get cash. When we buy equipment, we're using cash. Same thing for intangible assets. Purchase stocks and bonds as investments, not our own issuing of stocks or issuing of bonds, but purchasing stocks and bonds of other companies. That's an investment. Lending and subsequent collection of the money loaned. And so the overall investing, receipt from sales of equipment, receipt from sales of investments, stocks, bonds, receipt from repayment of loans by borrowers. On the outflow side, we're buying stuff, payment to purchase property, plant, equipment, and intangible assets, or payment to purchase stocks, bonds, and other securities, other than cash equivalents, which are current assets. Those are used for the day-to-day. Payments made to lend money to borrowers. So money going out the door, again, that's an outflow or use of funds. And preview financing, lenders and shareholders. Long-term debt, equity. Examples, receipts from issuance of common stock and preferred stock and from sales of treasury stock. So if we sold treasury stock, we got money for it. If we buy the treasury stock, that's an outflow or a use. Receipt from issuance of bonds payable, mortgage notes payable, and other notes. We get any loans, somebody else's money, that is a cash inflow, as opposed to payments to get treasury stock, payments of dividends. We do need to include dividends as an output flow from equity, and payment to settle outstanding bonds, payables, mortgage notes payable, and other notes payable. So if we're cash is going out the door to settle these long-term type issuance, those again are outflows. So hopefully you got a pretty good flavor of what it looks like in examining a cash flow statement, the operating, investing, and finance sections. And with the indirect method, the changes from last year to this year. So if inventory increases, that's a use of funds. If inventory decreases, that is a source of funds. If we have accounts receivable decreasing, that means we got paid, so that's an increase of funds. If accounts receivable increases, we're giving a loan to our customers, and it could be a 30 or 60 short-term loan, but it's still a loan. That's considered an outflow. That's the chapter. That's the first part of this module, the overview of the cash flow statement. Thank you for indulging. Talk to you soon.